Good morning and welcome everybody. My name is Philip Field. I'm the Lead Ombudsman for Banking and Finance at the Australian Financial Complaints Authority, and I'd like to acknowledge the people of the Gadigal people of the Eora Nation as the traditional owners and custodians of the land on which we meet today, and I pay my respects to elders past, present and emerging, and elders from other communities who may be with us here today. I'd like to also welcome those who are joining us by webcast, and for those of you who are on the webcast, you can download the resources we are talking about today through the webcast resources tab on the bottom right hand part of your screen. Additionally, if you have any questions as we go through our discussion today, you can submit questions through the very handily named Ask a Question tab at the bottom right of your screen. Also for webcasters, if you are experiencing technical difficulties, please call our webinar technical support on 1800 733 416. Now, for those of you who are in the room today, and welcome, it's a very long room. So hopefully those people down the back can see me, which is, if you can't, it's probably not a bad thing. Now, because we are webcasting, of course, please, if you have a question, wait for the microphone, raise your hand and wait for the microphone, and we'll come to you so that people not only in the room can hear the question, but also those who are online can hear you. So thanks again very much for coming along, and I'm joined today by Diana Ennis, Executive General Manager Resolutions, Tim Goss, Senior Manager for Banking and Finance, Jeff Brown, well, I was going to say new Lead Ombudsman, but no, you've passed your new date, Jeff, so you're just our Lead Ombudsman for small business. And finally, Jeff Bant, one of my fellow Banking and Finance Ombudsmen, who are all going to do some brief presentations for you this morning. So, we're going to talk about the Royal Commission, a snapshot about complaint numbers, some trends in banking and finance disputes, a bit of an update on process and procedures, including the legacy disputes going back to January 2008, conciliations, small business jurisdiction and responsible lending, and we'll be taking questions both in relation to all of those things and generally as we go and at the end. So a packed program this morning. Question to please increase the volume. So thank you very much for that. So the Royal Commission into financial services, the final report was handed down at the beginning of February, and I'd just like to take you through some of the highlights of that. So the outcome of the recommendations was to strengthen and expand protections for consumers, small business, rural and remote communities, to raise accountability and governance standards, to enhance the effectiveness of regulators, and you may have seen already in the budget last night, an extra $600 million for ASIC and APRA over the next few years, and provide remediation for those harmed by misconduct. The government has agreed to take action on all of the recommendations, except for mortgage broking commissions, which has been delayed longer than certainly recommended by the Commissioner. Now, focusing on the recommendations for banking, there was a recommendation to introduce enforceable code provisions by law for codes of practice, and the Treasury has released a consultation paper on that a week or so ago around how that might work. Also, the Commissioner recommended that the code enhance protections for people in rural communities who don't speak English, and particularly for Indigenous customers, around making the ID process much more effective, and no formal overdrafts for customers who have basic bank accounts. And I know you've all been promoting your basic bank accounts to those who qualify, and will no doubt continue to do so. In relation to mortgage broker reform, there's a recommendation that customers pay the broker with no trailing commissions, and a transition to an obligation to act in the best interest of the customer, and for car dealers and other merchants to remove the point of sales exemption so that dealers are subject to the consumer protection provisions of the National Consumer Credit Code. In relation to small business and primary production, a recommendation that the code increase its jurisdiction to any business employing fewer than 100 full-time employees, and it has a loan facility of less than $5 million. That's a recommendation we certainly support because it matches our definition in the AFCA rules. However, the Council of Financial Regulators has seemed to indicate that they're prepared to accept the $3 million gross cap and the $10 million turnover tests with a review in 18 months. So that's a question of waiting and seeing. In relation to primary industry protections, a recommendation that there be a national farm debt mediation scheme, again something that's been talked about for some considerable time. Now, you should note that in relation to farm debt mediation, the AFCA rules now contains a provision that if a matter does not settle at a farm debt mediation, the customer can bring their claim to AFCA, which is a bit of a change, and that also reflects a provision that's in the new Code of Banking Practice, but that will apply broadly to any financial services provider who engages in farm debt mediation, irrespective of whether or not they subscribe to that code. Also, the valuation of agricultural land is to be independent of the loan application process, and a recommendation that experienced staff be engaged for distressed loans, offering mediation, recognising appointing a receiver is a last resort, and that default interest should not be charged, because, especially when there's no realistic prospect of recovery, which is again something that we've said because, frankly, what's the point? If you're not going to get your money back, you're not going to get your default interest back, so it's becomes a bit of an annoying accounting exercise, in my view. Also, Commissioner recommended that ASIC have additional powers to approve and enforce industry code provisions. As I said, the Treasury is consulting on those, how that might work. To establish a compensation scheme of last resort. And again, in last night's budget, there was some money allocated to explore how that will be set up, and it will be administered by AFCA. And it's certainly something that AFCA and its predecessor schemes have been calling for some time. So we're very pleased to see that that's going to get implemented. A number of provisions around ASIC enforcement reviews, simplifying the legislation, and one that's of importance to everybody is to amend the Corporations Act to require licensees to take reasonable steps to cooperate with AFCA in dispute resolution, especially around providing information about the issues in dispute. And that provision in 912A will be reflected in other legislation, such as the National Consumer Credit Protection Act. So there will be a statutory obligation to cooperate with AFCA and to provide information, which again we're pleased about. Commissioner also recommended an expansion of the BEAR regime around remuneration for banks and their executives, and an overall around the requirements of how APRA and ASIC operate. And I think you've all by now be fairly clear that ASIC has moved to a why not litigate stance in relation to enforcement. Some specific findings in relation to AFCA. So, as I said, there's the provisions around 912A about obtaining additional information, the compensation scheme of last resort. There will be a payment of $30 million in compensation owed to 300 consumers and small businesses for unpaid settlements and determinations of FOS and CIO, the establishment of a forward-looking compensation scheme, an expansion of our remit for 12 months to accept applications for disputes dating back to January 2008, and Di's going to talk more about that in a moment. and the enhancement of AFCA's role in the establishment and public reporting of remediation activities. So we will be playing a much more active role in that, and we will be particularly concerned around the length of time it takes to implement remediation programs, with a view that they be implemented much more quickly than perhaps they have been in the past. So that's a quick summary of the Royal Commission. I'm happy to answer any questions that anybody might have. If you do have a question, pop your hand up and we'll get a microphone to you. Di, are there any coming in online whilst?
Apologies, we've got problems with sound.
Oh.
If they're resolved, but if they're not resolved, please keep emailing them to us.
If you can hear me, if you have a problem with sound, please keep emailing us. We think we've resolved them, but also turn up your volume. And I guess, well, you know, the old great IT advice, turn it off and turn it on again, that often works. But I'm sorry about that for the sound problems. Any questions in the room? Excellent. You're all on top of the Royal Commission. And as I said, one of our key focuses is going to be around systemic issues and remediation and remediating quickly. So the message to take back to your organisations, if you're a financial firm, is that they're going to need resources to implement these things, because having a lack of resources will not be an adequate excuse anymore. Di, over to you.
Take your glasses. Morning, everyone, and morning to those of you who are on the webcast who hopefully can hear us now. So if not, I did watch a Google thing the other day from the IT crowd. It's on the YouTube. If you ever want a really good laugh about IT support, Google IT crowd customer service, and I guarantee you'll laugh for about 4 minutes. It's very clever. Welcome everyone, and just want to introduce a couple of people that we've got here also from our Sydney office, in addition to the panel that we've got here. Julius Cox started with us in mid-January as a senior manager. He manages across the Sydney office, so if any of you want to have a catch up with him after today, feel free. We've also got John Fisher, also from the Sydney office. Perfect, fantastic wave. And there's a lot of staff at the back who are caseworkers. I don't know if there's any other managers up the back, but I think they're caseworkers who are happy to answer any questions and also have a chat about anything in particular. So, such an exciting topic, statistics, and I always get it. So where are we? I think most people in the room are looking a bit weary, and a lot of our staff are looking a little bit weary too, because in the first 5 months we've basically received about 30,000 complaints. So we originally projected when we launched on 1 November, that we would receive 55,000 complaints for the year, first year of AFCA, but we're already at 30,000 5 months in, and we're consistently receiving about 6,000 to 6,500 complaints a month. The good thing about that, though, is that we've closed 55% of them. So whilst we've been receiving a lot of complaints, and we're also dealing with the legacy scheme complaints, so there's the FOS legacy scheme complaints and the CIO legacy scheme complaints, we're also managing to finalise the AFCA complaints. For this room, 61% of the complaints we're receiving relate to banking or finance products. So really the significant proportion of the complaints that are coming into AFCA is from your sector. The next one on the list is 22% coming in for general insurance, And then surprisingly for us, and it's not something that we anticipated, superannuation is the third cab off the rank in terms of complaint volumes. So we did not anticipate that we would be getting the volume of superannuation complaint volumes that we have. $67 million worth in compensations been awarded, and we've received just under 2,000 small business complaints. And with Jeff Brown here at the helm, it's a bit confusing because we've got Jeff Bant and Jeff Brown, so it's GB and GB. So I think we have to do GB1, GB2, a bit like B1, B2. Jeff is across some of those small business complaints that are coming through the door and how we should be treating them, and we've got a pilot going on there. Out of our 36,000 members across AFCA, 11% of them have had complaints with AFCA. So that means that 11% of you possibly sitting in the room are the lucky ones. The balance of them haven't had a complaint. Systemic issues, we've had 81, and we've had 13 serious contraventions. So that's under new RG 267, and that's since 1 November. So the key issues and themes and the top 5 issues. Under general insurance, you can see there's delay in claims handling, denials of claim up in the top, and service quality. Also under investments, you can see failure to follow instructions or inappropriate advice being the second top one. But again, there's service quality as well. If you look at the next slide, superannuation's issues are incorrect fees and charges. So fees is another feature, so you can sort of see some themes coming through. Delay in claims handling, denial of claim. Again, for life insurance, premiums, denial of claim, delay in claims handling. What that says to us, and what Philip touched on earlier, is that if there are delays with these things, are there adequate resources in your organisations to deal with these matters when they come in the door? Because if you've got complaints about delays, that tells us that there possibly aren't. So if we get to the credit products, banking and finance area, payment systems, we've got a spike in unauthorised transactions. We've been saying that for a while. Deposit taking, we've got unauthorised transactions as well. Again, common theme, service quality, incorrect fees and costs. So if you have a look at this in terms of issues, it really is consistent across the board with all the products that we're looking at AFCA. So what does it mean for banking and finance in terms of the top 5 issues? What we're seeing, firstly, is credit reporting as a key issue. Secondly, responsible lending. And then, disappointingly, number 4 is financial firms' failure to respond to requests for assistance. So that's financial difficulty. A lot of the responsible lending matters that were raised in the Royal Commission probably have then spiked an interest in that, which is where we've seen a particular increase since some of the hearings on responsible lending. But it also is a question of what are you doing with those sorts of claims when they're coming into your business units, when they're coming into your IDR area and when they're coming into your EDR area. And what is it that prevents you from resolving them before they come to AFCA? Because they're the things that we really want you to do. We want you to resolve those matters when we refer them back. In terms of complaints received, so when I talk about complaints received, I talk about complaints that are coming in and being registered at AFCA. So that's 18,000, just over 18,000 complaints in a 5-month period. That's a huge volume of complaints that is not being resolved by financial firms in the first instance, or that are bypassing a financial firm in the first instance because there's potentially a lack of trust or a lack of engagement about the ability to resolve it. So this is a figure that we talk about a lot. For those of you that are new to AFCA, what we call it is our known closure rate at registration and referral. In simple terms, complaint comes into us, we receive it, we refer it back to you for registration. There's different IDR or post-IDR timeframes that everybody would understand from our G267. And if it doesn't resolve there and progresses to the next stage of our process, then it falls outside this statistic. This statistic relates to those matters that actually resolve in that referral back process. So what this tells us is that around in the banking, so overall at AFCA, which is the bottom line, for February, 35% of complaints resolved on referral back. That's fairly low. We would have normally over recent months tracked a bit higher because you can see November was 42, but what you can see is the volumes were, the resolution rate was higher prior to 1 November, and since AFCA's come about, the resolution rates have decreased. They've significantly gone from 42 to 38 down to 35%. So what that means for someone like me who's not a great mathematician is that 65%, is that right, Tim? Because he always checks my maths. 65% is coming through to our caseworkers. What we'd like to see is that figure being well over 50%, particularly with the higher volumes coming in through the door at the initial entry point at registration. And if you have a look by sector, banking has been in the 40s. Often banking traditionally has been in predecessor schemes up over 50%. The next product area to follow in terms of resolution rate is GI. They pipped banking in January, but then fell below it in February. Investments and life is particularly low. Superannuation started out really well. You can see that line for those of you at the back, it's the one that's only got the 4 months. So they started really well at the starting gates and it's sort of decreased since then. So the complaints, the 18,000 odd complaints that we received referred back, there was a percentage resolved. That meant that we had just over 9,000 complaints to move into our case management teams and review whether it should go through a fast track process, a standard or a complex process. When we're trying to review whether something should go through a fast track process or a standard or complex process, one of the things we need from you is a response. And this data is actually really disappointing, I'm sad to say, because what this data is telling us that 25% of the matters that move through to case management have no response from financial firms. That's a pretty high figure. And I don't know that we've seen it that high for some time across the board in banking and finance. The overall response rate at AFCA is 22% for non-response, but that means that a quarter of the files that the caseworkers in the back of the room get allocated actually don't have anything on the file. So sometimes they're really struggling to even work out what the value of the claim is. Is it a fast-track single issue under $15,000? Should we stream it there? Should we stream it to complex? How are we going to handle this? It also makes a timely engagement with the parties not so meaningful, because if we're ringing up the complainant to start with to talk about the issues in the complaint, I suppose the question to you is what sort of message does it send to your customer that we've received it and you haven't even responded to us? So in terms of community expectations and customer experience and all the media that there's been in relation to the Royal Commission and what we should be seeing from an industry that needs to be really picking up their game with certain things, this is not a positive figure. Financial difficulty complaints has also come up quite a bit. We've received a lot more than usual, and that comes into those top issues. So the concern there is why consumers coming to us or needing to come to us, either because they haven't come to you or because you haven't been able to resolve it. That often is a question of trust around collection activity. When they come to us, they know collection activity is put on hold. So my question is, what conversations do you have with them about collection activity while you're trying to work through whether or not you'll enter into a repayment arrangement with them, or what adjustment you'll give them over the time while they're experiencing hardship? Complaints closed by status. What we've closed in banking and finance is 14,245 complaints. That is across AFCA and the legacy complaints at FOS. It does not include the CIO legacy complaints. That's because we don't have the ability to merge that data. So that's exclusive of the Sydney complaints. One figure that I would really highlight to everyone in the room and on the webinar is the statistic for the volume of complaints that were closed at case management level 1. So there were over 2,000 complaints closed there, which is 16%. So the question for you is, what could you have done differently to close them in registration and referral? Why did they need to come through to case management 1? You're of course going to be paying a higher fee for that closure rate. We're happy not to take that higher fee and for them to go and get closed in registration, most definitely. But what was it? We accept that in some circumstances, if you've made an offer, sometimes parties want to speak to an independent third party about that offer. But what I would look at is the complaints that you've provided to us without a response and whether they fall within that case management level 1. And if you're struggling to provide responses and struggling to resolve things at case management level 1, it also indicates to us potential resourcing issues in your IDR and EDR areas. 3% have been closed at decision and 14% at rules review. There have been a number from rules review where when AFCA launched on 1 November, consumers felt that if they'd previously had a matter heard, they could come back to AFCA. So I think you'll see that number declining over time. There was a little bit of a spike of those. Closed by outcome type. What we do often get asked is how many decisions do you make in favour of a financial firm versus a complainant? So in terms of the decisions we've made, 2% are in favour of a financial firm, 1% in favour of a complainant. And similar with, it's interesting that preliminary assessments, which are recommendations or verbal preliminary views that our staff provide over the phone or in a very brief letter, it's a very similar statistic. The discontinued figure is one of the ones we watch closely, which is at 8%. The reason we watch that closely is we want to make sure that our services are really accessible to people and it's not too difficult for them to be involved in the process through what we ask for and how we ask for information. That also extends to you as members. So that's a figure that we do look at very closely. That's pretty much it for the statistics part of things. Does anyone have any questions about those in particular before I move on to process and procedures?
It's always a good plan. Now, is that working? Yeah, coming through, Di. Does the lack of response indicate that the complaint has no substance and they believe a resolution will not be achieved and it is a waste of time contacting the borrower? Do you have any statistics on why the financial firm have not responded?
In our experience, generally they've not responded because of what I indicated earlier, that there's a resourcing issue and people just haven't got to do the response. I suppose to the question, my concern would be if you've got a customer that is with you at the financial firm and they've raised concerns with you that haven't been satisfied, or you haven't clarified your position adequately enough, then if they came to AFCA, wouldn't you think it was an opportune time to re-engage with them to have that conversation? Because they are your customer, and in the current environment where we're at, if you read the paper, you read the media, it's all about that customer experience. So it would be disappointing to see a member that wouldn't want to engage with their customer when they've got an outstanding concern.
Can I just add to that? I think the question was, is it suggestive that there's no merit to the complainant's response, to the complainant's complaint? I guess another thing to note there is that there's an obligation on a financial firm to provide a response to a complaint. You may not necessarily be able to resolve it, but you need to be able to respond to it. Similarly, you're aware that AFCA's involved as well, so if it's a matter that you're unable to respond, then what we need from you is information to enable us to be effective at trying to work with parties to be able to deal with that particular complaint. So there is no suggestion about merit in terms of the financial firm's responsiveness to providing information. It's not really relevant to the question at hand because there is that underlying responsibility and obligation on financial firms to respond to complaints.
And of course, we don't know it's not without merit because we've only got one side of the story. So we need both sides to be able to form views about a whole range of things. Another question, what's the response time frame from AFCA to its member if we have a query relating to complaints? Tim, that might be...
Well, it depends. It depends on what the query is. So if you're asking us for general information about how a complaint process works or such, we should be coming back to you as quickly as we can to put you in the position that you need to be in to be able to resolve the matter effectively with your customers. And certainly if that's not your experience, we certainly want to hear from you and give you the information that you need to be able to resolve matters. If we're formally asking for information from you in response to a complaint, then the time frame you have will depend on where the complaint is within our complaint resolution process. Within the registration and referral area, generally it's 45 days if it's within our IDR stream, or 21 days if the matter relates to financial difficulty. If it's within our post-IDR stream, so it's already been through an IDR process before the matter was even registered with AFCA, then it's a standard 21-day response time. But again, the time frame from AFCA to ask for information from you will depend on where a complaint's at. But you asking questions of us, you can expect for us to respond to those questions, certainly in a timely manner, to put you in the position you need to be in to resolve the matter with your customer.
That's correct, Tim. And if I can just add to that, on the Secure Services portal, there is a document which is a contact list, and you're able to find out who your caseworker's name and contact details are, but also who their manager is, who the relevant senior manager is. So if you're finding that you're not getting return calls as you should be, or responses to your information, you should be escalating that to their manager or to a senior manager or to myself.
Now, a couple of housekeeping issues. These slides, for those of you who are online, are available from the Resources tab if you want to download them there. If you're here, they will be sent. We'll send them to you. So they will be available afterwards. And a couple of questions coming through about complaints against mortgage brokers, and we hope to be able to get back to you a bit later in the seminar in relation to that with some more information. And finally, the highest issue is credit reporting at 193.5. What is an example of a credit reporting type complaint? Generally, it'll be around a default listing on a credit file, but more recently, of course, as the big four banks move into repayment history information, we're starting to see disputes around repayment history information as well. So default listing and repayment history are typical examples of that, and of course it's always important to make sure your processes meet the requirements set out in the Privacy Act and Code.
The other one is credit inquiries as well.
Credit inquiries, so whether or not a credit inquiry should be on a credit file, because that does impact on credit scores apparently.
Any other questions, Philip?
Not online, at the moment, but we've got one in the room. And Claire's just coming with a microphone now.
Hi, just a quick question. Why? Because I'm surprised with the lack of responses that you're getting. Because if I get something from AFCA or the old FOS, I sort of do it ASAP so it doesn't escalate. Why don't we put the non-respondents on a league table? You know, they're all excited to be on top of the equities league table or something like that. But from a customer retention, you wouldn't want to be on top of that league table.
Well, actually, I'm going to be talking about our comparative tables in a short period of time in the next lot of slides, which is a little bit along those lines too.
And we certainly do for, we provide monthly reports to the Big Four and the next tier down, which does have that figure on a de-identified basis, so they know, at least as against their competitors, how they're tracking. And of course, they'd be terribly embarrassed if somebody was beating them. So they would work harder to make sure that didn't happen.
And where it's also prolonged and it's not a blip, that's a matter that we can report to ASIC as a systemic issue, and we have in the past. So they're matters that we do deal with. It's just that that's between us and our ASIC reporting. So I will move on to AFCA process procedures and updates. So, when the Treasurer announced his government response to the Royal Commission and said that AFCA would immediately be able to take complaints dating back to 1 January 2008, there was a little hitch with that. We actually didn't have the power on that day to take them. So even though we got a lot of calls and we got a lot of information from consumers asking us to take those type of complaints, we didn't actually have our authorisation conditions amended till the 19th of February this year. So now our authorisation conditions have actually been changed, and it requires AFCA to take complaints where the conduct has occurred on or after 1 January 2008. I have to concentrate when I say that date. So what that means is there's a 12-month window to deal with those complaints from 1 July 2019 to 30 June 2020. Many of you will be aware that we're currently running a consultation on those rules and amendments to our rules, which also includes the operational guidelines that gives a bit more context to how we're going to interpret and apply the rules. While the terms of the authorisation conditions are set in stone in the instrument, what we're consulting on is whether or not there's better explanations, or do you have information that you'd like? Should we clarify better in the operational guidelines, or do you have any questions about particular rules? So really encourage everyone in the room to have a look at that and provide your feedback. I think you've got one more week from this Friday, because the submissions close on Friday the 12th of April, which is the end of next week. And what we've done here is include links. So when you get the pack, or for those of you that are in the webcast, you can have a look through those links now. For others, otherwise go to the members section and you'll see the consultation paper, the draft amendment to the rules and the draft amendment to the operational guidelines. So what happens after that is we'll go back, have a look at the rules. It'll go to the board, then it will have to go to to ASIC for approval, because ASIC approves the rules, and then will be in force from 1 July. But we have had a number of consumers coming to us asking us to look at complaints, or alternatively they've lodged a complaint where part of the matter falls within our current rules and the other part would fall within the rules from 1 July. So what we've been doing is asking members for consent to look at those matters, because we can look at matters by consent from both parties, which currently may fall outside the rules. So we've actually added a new case action to the Secure Services portal, and we'd like to see people take a proactive approach to this. We have been. Pretty much if a consumer's really concerned and got queries about something that's arisen a significant time ago, we don't really want to turn them away and say, come back to us on 1 July. So we'd prefer that you provide your consent and we can look at the matter now. So that's what we'd be coming to ask you for. Can I just take your question at the end? Is that okay? Thanks. In terms of the case action, you can action that in Secure Services, and what we would ask you to do as well is if you have consumers coming to you or small businesses coming to you about matters that fall within this remit, we'd ask you to encourage and talk to them and try and resolve it in IDR, because the best case scenario for all these complaints, for every complaint and for every customer, is that you don't need AFCA involved. It's a much better customer experience for them to have their matter resolved directly with you, quickly, without having to go through a formal investigation process and outcome. So we'd ask you to have a look at it. If it's lodged with us and from 1 July and it comes to us, we will be referring it back to you for a 45-day period. So there will be a standard IDR period of 45 days for these complaints from 1 January. The reason we've done that and we've had discussions with ASIC is we understand some of these complaints may take time to find relevant information and documentation, and we think that the flat 45 days will also assist in giving you a bit more time to try and resolve it directly with your customer. The other thing is, please be mindful. One of the significant volumes of complaints or the significant reason that complaints go to our rules team is where members raise objections to us considering it. That's the main reason they get streamed there first before we look at them and put them into either fast track, standard or complex. What we would ask you to do is have a really close look at it before you put that case action on there, jurisdiction disputed by financial firm, and see would it fall within the remit, is part of it in currently but other bits are out, or do you think the right thing to do is allow AFCA to have a look at the complaint if it's something that's long-standing and been going on for a significant period of time? So really, if you could think about those matters before you dispute jurisdiction. Because at the end of the day, whether we can look at something or not, you've got an unhappy customer. Reporting. One of our obligations with reporting, apart from having obligations under RG 267, there's also consultation going on, or soon to commence, with RG 165 for the IDR reporting with ASIC, is to make sure there's transparency, and accountability is also a key feature, and the gentleman in the room that then talked about that, that's one of our key aims, is transparency and accountability. What does that mean for financial firms that have complaints with AFCA? From 2019-20, we currently have a rule under A14.5 that says that if we publish a determination, it will be de-identified. That's a current rule. What we will be doing is consulting on changing that rule to actually name the financial firm in determinations we publish. We'll be coming out consulting on that in May, June. Naturally, the complainant's name won't be put in the decision because there are privacy issues for them that we need to adhere to, but in terms of financial firm accountability in the current external environment and where community expectations are at, our board felt it was very important that we actually name financial firms. That also applies to definite systemic issues from 2019-2020. So we will, in our public reporting, be naming financial firms where there's a definite SI. In addition, we've got the comparative reporting that's about to commence, which is under RG 237. Previously, with comparative reporting for legacy schemes that have been done on an annual basis, the change is it's going to move to every 6 months. And we've been having key discussions with ASIC about these changes and how we, as a new organisation, will report this data. So we will now be reporting, and this will be communicated to you through our portal and information on our website, members portal, raw data received by a financial firm and by product group. So it won't be chance data, which some of you may be familiar with from predecessor schemes. It will be the raw data, and will continue to include business sizing metrics based on your information. So there's appropriate comparability based on business size. The comparative reporting will likely be published around October 2019, but as I said, we'll be coming out to you with information about that process shortly in a consultation. So the AFCA board recently considered our funding requirements with 1 July on the horizon. As I told you earlier in the slides, there's pretty apparent that we've received a significant increase of complaints from industry. As a result, we've had to do what we're asking you to do. We've had to resource up. So in the last 8 months, we've put on more than 250 staff across our Melbourne and Sydney offices. Pretty much those 250 staff have been operational staff, not support staff. So it's pretty much people to deal with those volumes of complaints coming in the door. And we're still out recruiting to get more staff because we've still trying to get through volumes. We're operating over 3 sites. We've got 2 sites in Melbourne because we've outgrown our accommodation in Melbourne. We've got a site up here in Sydney. We're looking at more space in Sydney because as we continue to recruit, many of our staff at the back will nod. They're moving desks regularly and we're trying to find where we can put people to deal with the incoming volumes. Complaints are tracking about 42% higher than all the predecessor schemes with no sign of reducing. And superannuation are more than double. We estimated superannuation complaints will be about 5%, but they're about 9% of what the forecast was, and also well above what the Superannuation Complaints Tribunal previously had. Also, as you understand, when you put on 250 operational staff, you need support staff to deal with that, and you need infrastructure and systems that go across multi-sites. So the exponential growth necessitates different systems. The board has, however, been very mindful to take a user pays approach to any increase in fees and levies. So going back to the original slide I talked about, that 11% of the 36,000, it's that user pay, so it's the ones that are getting the complaints that the board feels should take the share in the increases with these levies. So what that means is we're going to be coming out and talking shortly to Engage to talk to you about changes that we're going to be making to the user charge. It's currently $5 million. That'll be going up to $10 million. Complaint fees, normally we would increase them by CPI, but it's going to be a lot more than CPI, probably roughly up to 10%. And there will be an proportional increase to the superannuation levy as well. So we're in the process of settling our budget for 2019-2020. Understand a lot of you will be in the process of settling your budgets as well, and we'll want to have some idea about this, so we'll be engaging with you shortly. As soon as we've settled on those increases, we'll communicate them to you. So larger members will be hearing from us. if you don't have many disputes or you have no disputes, I suggest you go to the Secure Services portal. You can email our membership team or call them on 1300 565552. So ending on that note, I did have a question in the middle of the room. So Claire, if we can... Thanks.
Yeah, Steve McCollum from FinConnect. I work for a aggregation and mortgage broking business, and typically when we've got data that's no longer relevant or useful to us, we would de-identify or destroy it. So my question then relates to the change of rules where you can consider complaints going back to 2008. We may have destroyed the data. Should we now be holding data to 2008?
Yeah. Look, we would encourage everyone to go back and review their document retention policy and not be destroying stuff. I understand a lot of people stopped destroying documents when the Royal Commission came into play last year, so there were a number. We would encourage you not to destroy anything from this point in time. And we've also put some guidance in the operational guidelines about where you're struggling to find information or documents. I don't know, Philip, if you want to expand on that, but where you're struggling, because that's one of the things that we're anticipating, and a lot of feedback from members has been that we're concerned because we may not have relevant documents anymore. So I think we're going to be talking about that on a case-by-case basis. What you've got to do is give us what you can, explain what steps you've taken to find information that may not be readily available, because I do understand there's a lot of mergers, takeovers, books being sold here and there, and it's really challenging sometimes where organisations have morphed into different entities. So have the conversation with us, and the key thing is don't go silent. When we ask for documents, if you're struggling to find the documents, talk to us, don't go silent.
No, I've got nothing further to add on that at this stage. Couple of questions coming in online about some of those things, Di. Someone asks how much are the fees payable if the complainant accelerates to the next level?
So that's in the case fee guide, which is available in the Secure Services portal. So I suggest you go there, and if you can't find the document, give a call to our membership line. And with the legacy complaints, can AFCA consider it if it's previously been dealt with by FOS? But a follow-up to as well, what if there's new information that wasn't brought to the attention at the time? So previously dealt with by a legacy scheme or by a court at the moment is excluded from those legacy complaints. In terms of if there's new information, I will echo Tim's comment earlier of it depends. Generally, we would say it's been dealt with, but if there was something that was intrinsically unfair that had been potentially withheld by a financial firm that has now just come to light, then we may have a look at that, Philip, mightn't we?
We may indeed. We may indeed. A couple of questions about opening. Are there plans to open offices in other states, particularly in Perth? It's certainly something that we're talking about, so it hasn't been ruled out at this stage, but no definite plans?
No definite plans. I'm going for Tahiti. I think we should sort of take a few sort of running sheets on that, but
I'm with you there.
No definite plans, but we're investigating all options to expand. So it's on anything's on the possibility on the table.
And a question around naming firms: is it a mechanism to shame firms into resolving matters early to make complaints go away to avoid the potential reputational damage?
I think it's really a measure of just accountability, and firms were accountable in the Royal Commission under that lens, and I think it's just an extension of that lens.
Although if it does have the effect of less determinations, personally, I'll be happy about that.
Well, I think we all will, because We want you to sort them out. Any other questions? Perfect.
All right, thanks, Di.
Thank you. I will hand over to Tim Goss, who's one of our other senior managers from Melbourne. And Tim is extremely passionate about conciliations, given that he set up a lot of the conciliation process through the financial difficulty process. So I'm going to hand over to Tim, who will share his passion.
Thanks, Di. Good morning, everyone. It's lovely to be here today. I flew in from Melbourne at 6 o'clock this morning into a very soupy Sydney weather after an aborted landing and then a successful re-landing, which was terrific that we actually made it down. I can reassure you that it's great to be here with you today. I'm here to talk about telephone conciliation conferences. For a few reasons. So if you're a former FOS member or a former member of the Superannuation Complaints Tribunal or a superannuation trustee member, then you'll be very familiar with conciliations as being a dispute resolution tool that's effective in resolving disputes. If you're a former CIO member, then you may be less familiar with this dispute resolution tool. Now, we're aware that a lot of you in the room today are former members of the CIO, and so we thought it would be helpful to spend a little bit of time talking with you today about our dispute resolution tool, which is conciliation, just to make you a little bit more familiar with it. It's also a shameless plug to encourage you to dial into a webinar, which we'll be conducting on conciliations on the 17th of April as well. So this will be a much bigger deep dive into conciliations on the 17th of April. At the end of our session today, details of that particular webinar will be circulated by us. So I do encourage you and your teams that are unfamiliar with conciliations or want a bit of a refresher into what they're all about and how to approach them to dial into that particular session. Now, as I said, conciliations is something that we do take very seriously at AFCA, and it's something that we'll be looking to use as broadly as we can. We do it because we find that magic happens within telephone conciliations. It's an opportunity to bring parties together to talk about issues that have created a divide between them for an extended period of time. So far at AFCA, we've conducted 1,380 telephone conciliation conferences since we commenced our operations in November. That number will continue to grow, and it will continue to be a focus for us to conciliate as many complaints as we can. As I said, conciliations are a guided conversation that's facilitated by someone at AFCA between a complainant and a financial firm. Who is guiding the conversation at AFCA depends. We have a specialised conciliation team, which is a team of expert conciliators that we have at AFCA, but our plan is for really all of our complaint handling teams to be experts in conducting telephone conciliations. So over time, you'll be dealing with lots of different people at AFCA within a telephone conciliation conference environment. And they'll be ably assisted by our conciliation team. Within our complaint resolution process, it's really our standard and complex streams of activity where we're targeting our conciliation activities. So matters that work through our fast-track process. Generally, we don't do telephone conciliation conference, but we do a lot of phone work for those particular matters, including a lot of verbal preliminary review work with parties over the phone as well within our fast-track process. But if you're dealing with banking and finance matters within our standard and complex streams, in particular financial difficulty matters, you can really start to expect to see that telephone conciliation conferences will be our default setting for matters that don't quickly resolve once they progress from registration and referral. Telephone conciliation conferences do take time, so it is an investment in time for the discussion to be had, but they don't take a lot of time. So on average, we find that they fall somewhere between 1 to 2 hours, depending on the complexity of the discussion itself. But many a lot shorter than that, and some will be a little bit longer as well. But it is a good investment in time up front, because many matters resolve without the need for complaints to be further investigated if a resolution is not found within the telephone conciliation conference environment. So how do we conduct a telephone conciliation? So we do a fair bit of work with parties, in particular complainants, before a telephone conciliation conference is conducted. All of our staff that are conducting telephone conciliation conferences are trained by the Resolution Institute Mediation, and we run their model of conciliation. And part of that is to ensure that parties are familiar with the process before they get started, so their expectations are met in terms of what will happen within that discussion. For financial firms that may not have been as involved in conciliations in the past, we'll spend a little bit of time having a conversation with you about the process, and we do encourage you to reach out to us as well if you're about to embark on a journey of conciliation and you're just not sure what to expect from that particular conversation. But primarily we'll be spending some time with complainants as well, because it's often their first complaint and likely only complaint that they will have with AFCA. So it's their only opportunity to orientate themselves with this particular dispute resolution tool. When we conduct a telephone conciliation conference, it commences with a bit of a welcome session. So that's everyone understanding who's involved in the particular conversation. They generally all happen over the phone, so we're connecting different parts of the country together to have the conversation. We'll set some ground rules to ensure that everyone has an opportunity to be heard within that particular conversation and explain our role through the conversation as well. We'll provide each party, so the financial firm and the complainant, with an opportunity to summarise their view on the complaint, and based on those combined summaries, we'll agree on an agenda that will guide us through the conversation. And that part of the conversation's really quite important, so we can ensure that all the matters that are important to all parties have sufficient time to be discussed. We'll go through a process of exploring each of the issues that have been identified on the agenda, and asks if parties have particular ideas for how some of these issues can be overcome. And as I said, we see unpredictable outcomes within telephone conciliation conferences when we bring parties together and they share their experiences of a particular point of difference. Often some really outside the square solutions can be found. Along the way, it's likely that our conciliators or case managers will take parties aside for a private session. That's just to use that time as an opportunity to check in on everyone, to make sure everyone's following what's been discussed and they're comfortable with how the conversation's progressing so far. Also within those private conversations, we may be suggesting alternatives to parties as well as a means to try to bring a matter to a conclusion. But certainly throughout the course of a telephone conciliation, we will be ensuring that everyone understands that what's happening and where we are within that process. And if an outcome is reached, we'll be spending a lot of time with parties to ensure that they understand what outcome that they may be agreeing to. So what we need from you for a telephone conciliation conference to be successful are a few things. So prior to the conversation, we certainly need to know who it is that you're asking to attend that particular discussion and where we can reach them. So it's really important that we have a phone number of someone that we can reach in order to have a telephone conciliation conference. So that's certainly some information that we'll need from you in advance. If you are appointing someone to attend on behalf of your financial firm, it's important that they have the authority to be able to make a decision within the conciliation conference as well. The purpose of the discussion, again, is to bring parties together and explore options for resolving the complaint. That's very difficult to do if the representative from the financial firm doesn't have the right sort of delegation to put some ideas of resolution forward. So there's various ways that can be done. but it is important that we do have access to someone from the financial firm's side that can make a decision on what possible solutions the financial firm is in the position of being able to agree to. Finally, and most importantly, we need representatives from the financial firm to know the case. So it's important that you do review all of the information that you have about the complaint before you attend the telephone conciliation conferences. These discussions can often be derailed if a complainant feels that they haven't been understood up until the point of a conciliation, and then when they are involved in a conciliation, their financial firm still has not read the information to understand what they're actually what they've raised complaints about. So it is important that you do have an understanding of the issues in complaint for that particular discussion. We also ask that you attend the conference in good faith and with an open mind. So you might have a bit of an idea of which direction you're comfortable in going when you enter into a telephone conciliation conference, but we need you to be open to the ideas of exploring other options of resolution as well. So approaching a matter with open mind is certainly important to us, and it will encourage you to find more favourable results through the use of this resolution tool as well. And if there's anything along the way, both prior to or during the conciliation conference, which may be an impediment, such as time restrictions or anything else like that, please let us know. We're happy to work with parties as best we can. In exceptional circumstances, we may reschedule a telephone conciliation conference, but we're really reluctant to do so unless we really have to. The reason for that is it's very difficult for us to coordinate the calendars of all parties to bring everyone together at the same time on the same day in order to have these conversations. So we do ask that you work with your dispute resolution teams and ensure that if you're not available to attend a telephone conciliation conference, then someone with a suitable delegation is able to step into your shoes to be able to attend on behalf of your organisation. At the end of a telephone conciliation conference, there can be three options. One is that the matter may be resolved, and we'll explore that in just a moment. The second is that there may be no resolution, and we'll have a bit of a chat about that as well. And the third outcome could be that parties walk away asking for some time to think about some possible solutions that have been put forward, and that's certainly not wasted time at all. So it's not unusual for us to conclude a conciliation conference where parties have a fair understanding of what they're willing to do, but they need a little bit of thinking time before they're willing to commit. So by all means, if you are involved in these discussions and that is a conclusion that's reached, it's not wasted time at all. But let's talk about what happens when an agreement is reached. So firstly, congratulations, you've resolved a complaint, and that's a terrific thing. By resolving a matter at conciliation, you've saved you and your organisation several hours of an investigation which will follow if the matter is not resolved at conciliation. So there's a benefit for you. In my mind, the larger benefit to you is that you've probably reconnected with your customer where there has previously been a divide. You've restored their trust in you and your organisation, and you've probably made a lasting impression on their life as well. And I think that is a really valuable thing for you and your teams to walk away from when you're successful at resolving matters at telephone conciliation conference. If you are successful in a matter being concluded there, then a couple of things may happen. So we'll certainly record the terms of agreement that were reached and provide confirmation to parties of what was agreed to within that discussion. And that, in most cases, is enough for the dispute to be finalised. If there's any question from either party about what we prepare in relation to what our understanding is of what was agreed, then we're certainly happy to have those discussions. But for the most part, parties are satisfied as that being the conclusion for that particular matter, and the complaint closes at that point. Sometimes financial firms may require that a settlement document is prepared for the complainant to sign and return, confirming that the matter is resolved. If that's the case, then within the conciliation, timeframes for that information to be prepared and exchanged will generally be agreed to. So everyone's aware of what each other is doing in order for the matter to be concluded. It's important that if your organisation does need a settlement document to be prepared and provided to the complainant, that it reflects what was agreed within the conciliation conference. And AFCA will be keeping a close eye on that as well. So we do encourage you to take strong notes to ensure that anything that's been prepared after the conciliation is reflective of what everyone agreed to within that particular discussion. So a lesson learnt here is to not outsource that particular activity to a part of your organisation that wasn't in the discussion, because it may be the case that that they're going off on a tangent to where parties settled. So I would encourage you to stay involved to make sure that anything leaving your firm after that conciliation conference is reflective of what you agreed to on the day. As a reminder though, complainants don't have to agree to resolve a complaint in a conciliation conference, and if they don't, then these are the activities that will follow. Firstly, before all of this, we'll thank parties for their involvement in the discussion. It's not a failure that a matter wasn't settled at telephone conciliation conference. Again, you've probably spent valuable time clarifying the issues in dispute, understanding each other's positions, so you'll be walking away with a much better understanding of where the matter may go. And this will assist the activity that will follow from AFCA when we commence a further investigation to ultimately decide the matter. In some situations within telephone conciliation conference, it may be that we'll be in a position to provide our initial view on the complaint, but the ability for us to do that is largely reliant on the quality of information that parties have provided us before we entered into the telephone conciliation conference. And as Di mentioned in her stats session, and it's always terrific to hear Di talk about stats, the non-response rate for matters progressing out of registration and referral is around 25%. So often our complaint teams don't have a lot of information when we're entering into these sorts of conversations. So if you equip us with the information that's relevant to the issues that we're considering, we'll be much better placed to be able to guide parties with the likely outcomes to the complaint if it doesn't resolve at telephone conciliation conference. We may also be able to tell you within that discussion whether or not we need further information from parties. So it may be through the course of the conversation it's clear that another issue is coming to light. If that's the case, we'll let you all know that that's an issue that we'll be giving further consideration into, and be in a position after the discussion to let you know what information we need to be able to consider that particular discussion. So, to break up all those words, here's a picture. This is a picture that's a flowchart. Really, it's a process. It's talking about our conciliation conference process. But really, the conciliation conference process is the column of activity that's on the left-hand side. So if you resolve matters at telephone conciliation conference, you don't need to work your way across to the right-hand side. But as you see, we will set a date for the conciliation, we'll contact parties to explain the process, we'll conduct the conference, and if an agreement's reached, then we'll record that agreement, an audio recording of that agreement, so then we can check to make sure that the information that we provide parties at the end of the discussion is reflective of the actual conversation that was taking place on the day. Similarly, if there's a settlement agreement provided by a financial firm, we can check that against the audio recording too. And if any party comes back and thinks that what they've received is not in alignment to what they understood, what was agreed, then this benefits all of us. So we can go back to the recording just to double check. But it's only that part of the conversation that AFCA will be recording.
On recordings, a fair few of you do have telephony systems where you do record all of your calls that are coming in and out of your organisations. We do ask that if you are invited to a telephone and attend one of our conciliation conferences, then you do so in a way that conference or that telephone conversation will not be recorded by your organisation. Some of you have rooms that are set up and equipped to be able to do this. Some of you have systems in place where you can stop conversations being recorded on phones. If you're not sure how your organisation is positioned in respect to that, then I encourage you to talk with your IT teams to ensure that things are going as they should be going. But if a matter doesn't resolve, then we follow the process to the right. So we will probably need to gather more information in order to provide our initial view. If that view is not accepted, then ultimately the matter will be referred to one of our decision makers to issue a final decision. That decision will be binding on the financial firm if it's accepted by the complainant. The exception to that is in our superannuation jurisdiction, which doesn't apply to this room. So I'm just going to skip that part of the explanation. In terms of the types of outcomes that we receive at conciliation, this is just a short list. The list really is endless of the types of things that we've seen agreed to within these discussions. So again, it's a conversation where often magic happens and really out-of-the-box solutions are applied to problems by parties coming together and putting their thinking caps on. But we see outcomes that include an agreement that more information will be provided, that maybe payments of compensation will be paid, that maybe an agreement is reached to end a financial service, or even an apology. And an apology goes a long, long way sometimes for these matters being resolved. For financial difficulty matters in particular, we see anything from repayment arrangements to agreed timeframe for sale of assets if that's required. And in order to facilitate that, we see often some really novel solutions, such as relocation costs to complainants and that type of thing as well. So we do see some great outcomes through parties participating in our telephone conciliation conferences. For all matters, for all conferences, all conciliation conferences that you attend as a financial firm, we will invite you to complete a survey at the end of that particular conversation. So if you are seeing things that you're not sure about or things that you love, you'll be invited to complete that survey and return it to us. We send that out about a week after the telephone conciliation conference was conducted. So by all means, we encourage you to let us know what your observations are along the way too. We also send a similar survey to complainants as well. But complainants let us know when they register their complaint with AFCA, whether or not they agree to being invited to be surveyed. So if at the commencement of their complaint with AFCA, they've said, please don't survey me, we won't invite them to complete that particular survey. But we'll invite you to complete all of them. So by all means, let us know what your observations are. Just a brief case study as an example of where things can take a bit of a right angle from a banking and finance lens for telephone conciliation conferences. This was an example in the past where complainants were parents guaranteeing their children's borrowings, which is always a great idea. They sought to be released from the guarantee on the basis that they did not know what they were agreeing to under the guarantee. The lender was a signatory of the 2013 Banking Code, which required a few obstacles to be overcome in order for the guarantee to be valid. The lender believed, going into the conciliation, that all of their requirements under the code had been met. Through the course of the conversation, the complainants advised that the guarantee was required to be signed on the same day, and it was also evidenced within the conciliation that one of the complainants was working interstate on the day that the lender's representative had dated them as witnessing the signature of the guarantee being signed as well. So there are some big question marks which came up within the course of that conversation taking place. This was a matter where the financial firm was having difficulty engaging with their customer to have this conversation beforehand. So bringing parties together enabled some of these things to be unpacked. As a result of that discussion, it was ultimately agreed that that the guarantee would be put aside, and parties walked away with an outcome to that particular matter. So that's just a very brief snapshot of conciliations. Again, we have a conciliation webinar which will be taking place on the 17th of April. So I do encourage you and your teams, especially if you're a former CIO member, to dial into that particular conversation. That'll be hosted by Julian Hughes, who's our team manager of our conciliation team, and I understand some of our conciliators will be involved in that particular webinar as well. We also have some publications that are available on our website which cover off conciliation conferences. I'm told that the conciliation conference brochure takes 7 minutes to read. It took me a little bit longer than that, but that's not unusual when it comes to me having to read something. But there are publications there that are available to help you through it. Predecessor schemes in the past, or certainly FOS in the past, reported on conciliations within annual review reporting as well, and I expect that AFCA will continue that trend too. So it's an area that you are able to keep in touch with. Do we have any questions? Yes, we have a question, Claire, towards the front.
G'day Tim, my name's Tatiana. I'm from Aussie Home Loans. In the normal alternate dispute resolution process, what happens in the conferences is without prejudice. I noticed on the screen it did say that if the complaint doesn't resolve, AFCA may use the information provided in the conciliation, including agreements, going forward. Is that right?
Yeah, that's right. That's right. So if there are matters that are raised within the conciliation that we think are relevant to the particular complaint, then we'll be talking with both parties about what was raised, and our view is that it's a matter that we should be looking into further.
Then what's the basis for not letting us record, or anyone record, the substance of the conciliation? If AFCA is going to purport to use anything provided in that in determination, what if there's a dispute about what was provided, what was said, what was agreed? Seems a bit inconsistent. It should either be nothing is used, it is entirely without prejudice and no party can use it, or there is a proper record of it.
Yeah, look, at this point we've reached a setting where we're recording the outcome of the conciliation that was reached, but line of inquiries may follow based on what we understand from both parties through the course of that conversation. So that will prompt a conversation outside of the conciliation where it is that we may need to seek more information to be able to understand those particulars further. It's hard for us to put aside an issue that we think is relevant to a particular matter that's been raised.
Again, it just seems to discourage open, frank provision of information if it will be potentially used against either party going forward. I hear what you're saying. I'm just raising it as a policy position.
The objective of our activity is to be open. So we will consider a complaint openly and try to find the fairest way forward to deal with that particular issue. So, look, I'm not really aware of too many circumstances in the past where we've heard something in a conciliation where it's important but would seem inappropriate for us to act upon it. Any other questions? Anything coming in from the wider world, Philip?
Yes. Well, there were a couple of questions about recording, which I think you've answered that one. Is consent obtained for the audio recording? Yes, it is. Someone's asked about if they believe the AFCA case manager didn't act impartially or weren't prepared. What's the process, either at the time of the conciliation or afterwards?
I mean, that's certainly something that is one of our questions within the survey that's done. But call us if you're not happy with the performance of any of our staff members about any of our complaint resolution process, including conciliation, I'd encourage you to go to our members portal, find who their manager is and have a conversation with them. If you're not happy with that, have a conversation with a senior manager. We're happy to have those conversations.
And at what point in time does the conciliation commence? And from that I assume at what part of the process. Now, presumably you need a little bit of information, if not all of it, but so not when is the appropriate time, Tim?
10 a.m? No. The appropriate time is, look, we want to hold them as early into our complaint resolution process as we can. And the purpose for that is that the quicker we can bring parties together to talk about their points of difference and find a way forward, the better it is for everyone. Where that is generally after our initial request for information, once the matter is allocated to one of our case managers, after it hasn't been resolved at registration and referral. Ideally, it would be somewhere between 14 to 28 days after that that letter is provided to you and complainants.
Well, thanks very much, Tim. That's all from online, and thanks again. And April 17, is it?
April 17. So information about the webinar will be circulated to you after today. But I'll be hanging around after this if you have any particular questions.
Thanks very much. Hand over to Jeff Brown. Thanks, Jeff.
Good morning. A lot of talking heads, aren't we? I think I'm still new to AFCA. It's 6 weeks in. I'll still claim new. I'm not too sure for how much longer, but I think 6 weeks is pretty new. I thought this was a good opportunity to introduce myself in Sydney. It's the first time I've been here for a forum. So I'll give you a very brief background to me. Many of you probably have seen that, but I'll just recap. I want to talk about my role because it is a new role in AFCA, or in fact for FOS. Look at our increased jurisdiction for small business, and again you'll be across that, but it doesn't hurt just to recap. And finally look at the elements of the small business pilot we're running and some data on small business at AFCA. So my background, there we are. My relevant background, my most recent role was as Victorian Small Business Commissioner for 5 years, and that's a statutory role. We dealt with small business, commercial, contractual disputes with other businesses, implemented the Farm Debt Mediation Act in Victoria. So I've had some relevant experience in dispute resolution with small business and, for that matter, with farmers and farm debt. I've had senior roles in the public sector prior to that. I've had senior roles in the corporate sector and have run my own small business. So a fairly broad-ranging set of experiences. In terms of the role, Lead Ombudsman Small Business, it is a new role for AFCA, and if you think about it, the other three Lead Ombudsmen are product-based. So you've got banking and finance, it's Philip, you've got general insurance, and you've got all the other parts, superannuation, investments, advice, and so on. Product-based, product line-based. But to establish a Lead Ombudsman for small business really cuts right across those product lines. It's a customer segment view rather than a product view. So it's quite an interesting step for the board to take. And it no doubt reflects the particular heightened interest in small business issues, probably coming out of the Ramsay Review and then reinforced through the Royal Commission. And it says to me something about the importance of putting a segment of customers, perhaps giving them a bit more profile in an organisation which in its predecessor schemes has been very focused on consumer. So I'm very pleased to be in this role. So while my role technically cuts across all those product lines, in fact, banking and finance I think will be where I spend most of my time. And when I looked at some small business data for AFCA for our first 5 months, 77% of small business complaints related to banking and finance. And if you recall Di's commentary earlier, across AFCA as a whole, all complainants, 61 or 62%, are in banking and finance. So it does seem to be a segment where small business really does congregate. The way I see the role, and it will evolve over time, is having three key elements. The first is I think I will be having a fairly extensive external stakeholder engagement role with small businesses, industry associations, small business advisors, accountants, lawyers, you name it. I think there is a significant awareness issue amongst small business of AFCA, and I'll be doing my best to explain what AFCA does and what our scope and scale and mandate is. And I would see probably 50 to 60% of my role being in that external engagement, certainly for the first 12 or so months. The second role I see is having an internal role as being a small business champion within AFCA. And by saying champion, I don't mean prejudiced or biased, I mean raising the issues or acknowledging the issues, pursuing better data capture, understanding what the data means for small business, understanding the issues that are emerging for small business, and where possible, being proactive in bringing that information to those external stakeholders. What is it I can say to small businesses out there, or their associations, that can help those small businesses not get themselves into the predicaments that we see every day? And the third element, understandably, will be dealing with determinations affecting small business in the main. So that's how I see the role. Those elements may move around over time, but as I said, I think in the first 12 months or so, a very strong external stakeholder engagement role. If I turn to the expanded small business jurisdiction of AFCA, which I'm sure you're aware of, we now have a definition of up to 100 employees, or 100 in a group. The claim limit applies to a facility up to $5 million now. It was $2 million. And we can issue compensation of up to $1 million, which is 3 times what it previously was, and indeed up to $2 million for primary producers. So a much expanded role, and I think getting that message out to small businesses is important. In terms of the small business pilot and some stats, I was fortunate when I arrived 6 weeks ago that in the banking and finance area, 2 teams had been put together predominantly focused on small business. So prior to that, everybody did a bit of everything. So for someone coming in with a mandate to understand small business issues, I was delighted to hear there were 2 teams, because it means I can talk to 20 people rather than 200 and find out about what they do most of the day as opposed to a little bit of the day. So that, to me, is a really big advantage. The team, using third parties, will commence surveying small businesses next week to find out about their experience in various stages of the complaints handling process. And that's driven by a continuous improvement requirement or desire, but also to understand a bit better the nature of the small business complainant. And what we do with that pilot will evolve again over time. Statistics. For the last number of months under FOS was dealing with 200 to 250 small business complaints a month. For our first 5 months, we've dealt with over 1,900, which equates to, around 400 a month, which seems like a pretty substantial rise. However, there's one specific issue which has resulted in over 650 complaints when one firm went into liquidation. So if I remove that extreme incidence from our aggregate data, it brings the numbers back to pretty much where FOS was before AFCA started, around that 250 a month. Now that to me is quite surprising, particularly in light of Di's comment that across AFCA as a whole, our total complaint numbers are up 40% in that 5-month period. So again, it seems to me there's an awareness issue out there for small business, that they need to know about AFCA and need to know about our expanded remit. And incidentally, of those 1,900 complaints, there's only been one instance where the complainant has been ruled outside the rules on a small business criteria, which was over 100 employees. So we've had no instances of anyone with a facility over 5 million to date, and only one where employee numbers exceeded 100. In terms of the product types we're getting a lot of complaints on, At the moment, 25% are under the heading of leasing. However, that large category of 650 odd complaints I mentioned is biasing those results because that related to equipment leasing. And so that high incidence of leasing is reflecting that strong bias. And equally, the dominant issue in the first 5 months is misleading information. And again, there'll be elements of that 650 odd set of complaints around allegations of misleading information. So it's not particularly great data at the moment to get a handle on the sort of complaints or trends coming through the door. One of the interesting outcomes to me, and it may be swayed a bit by that incidence as well, is that 54% of matters were resolved at the registration level, so bouncing back or going back to you for the first time, getting resolved, as opposed to 66% for non-small business complaints. So if that's reflective of the way you're dealing with small business versus non-small business complaints, there are a lot less being resolved at your level than for consumer complaints. And finally, when I spoke to the small business teams about what are they seeing coming through the door today, what's the intelligence as opposed to the data, if you like, the three areas they mentioned were relating to loan assessment and serviceability, guarantees and appropriate compliance with the Code of Banking Practice, and sale of securities when the loan repayments can't be met. So that's what they're seeing coming through today. So that's a very brief introduction to me and what I think I'll be doing and some of the small business stats. So thanks for your time. Are there any questions?
Yep.
Claire?
No, it's all right. Oh.
Hi, I'm Tim, a finance broker, and I've noticed that there's an increase in customers that I'm seeing that are doing things through websites such as check your free business credit score. And I'm actually noticing an increase. It's not an access of their credit score, it's actually a credit inquiry, and I'm starting to see people are damaging their credit scores, their business credit scores, and I think this is also happening with consumer similar websites. I think that should be a focus point for AFCA, that perhaps it's not being made clear enough for consumers and businesses, the difference between credit access and credit inquiry and the potential damage that can be done to their score.
Well, thanks for that. Good point. I'd be keen to get a bit more information from you. That's the sort of information I would like, if I'm focusing just on small business, to be able to explain and tell the small business associations out there. So perhaps I'll catch up with you later.
And one quick question down the back. Thanks, Claire. We're sort of running short of time, so...
Thank you. Adam Hopkins. One of the questions, one of the points you just made was around loan assessment and serviceability in the business space. Obviously, the Hayne Royal Commission did not recommend extending the NCCP provisions to small business. How is AFCA approaching loan assessment and serviceability in the small business space?
Yeah, it's an interesting question. Yes, Hayne didn't go into the full responsible lending under the credit code. But of course, you've still got those obligations of a diligent and prudent banker. And while that may not require with a small business all of the prescriptive steps and inquiries you need to take for a consumer, you still need to demonstrate to us that you're doing appropriate checks on capacity to repay. Is the loan or the credit for a clear purpose and objective? So we aren't really changing our approach to obligations to assess serviceability in light of the Hayne saying don't worry about responsible lending.
And that might be a good time to segue into Jeff Bant's presentation about responsible lending. And just while Jeff's coming up, I managed to get some statistics around mortgage brokers for you. And in the first 4 months, or maybe 5 months even so far, 85 complaints have been received about mortgage brokers. And the issues, the main issues are responsible lending at 13, incorrect fees and charges at 13, inappropriate advice at 7, and fee disclosure at 7. So some things around fees and charges seem to be the biggest issue there. So, but only 85, so not a lot. Thanks, Jeff.
Thank you, Philip, and congratulations. You've made it through to the most interesting part of this morning's presentation. What I'd like to focus on initially is just to go over the increase in monetary jurisdiction for AFCA, and I'll put up a slide shortly for that. I'd then like to make some observations about the Royal Commission. And we've heard a lot about what the Royal Commission recommended and what Commissioner Hayne has said, but I'd like to talk about what he didn't say and what was not recommended. So I'll touch on that, make some observations, and then I'd like to give some guidance on our approach to resolving responsible lending claims. Our approach is under review, but I'd just like to give some guidelines on our current approach and some important features there. For some of you, you'll note that it's strikingly similar to the FOS approach. So let's just have a look at the AFCA compensation and claim jurisdiction. And you'll see there the column on the left is the FOS legacy jurisdiction for monetary claims and compensation. Column on the right is the new AFCA jurisdiction, and you can see there that there's been quite some increase. So for non-superannuation complaints, a complainant can come to AFCA with a claim for loss of up to $1 million. Our compensation limit, though, is we can only award up to $500,000 in compensation. For small business, as we've just heard, we can award $1 million in compensation, up to $1 million if appropriate for small business. And for primary production, it's up to $2 million in compensation. So there you see significant increases in our monetary jurisdiction and the amounts we can award. The other column I just wanted to draw your attention to there is the jurisdiction in relation to guarantees where someone's provided a guarantee over their primary place of residence. Now in the past that was limited by our monetary jurisdiction, but no more under the AFCA rules. If someone's provided a guarantee over their primary place of residence, then there is no limit. We can review a claim about the provision of the guarantee without a limit on the jurisdiction based on monetary considerations. So there's a couple of important points to make in that table. So there's been a lot of discussion around the Royal Commission. Let's talk about what the Royal Commission did not recommend. Importantly, I think we should note that Commissioner Hayne made no recommendation for a new layer of regulation. So the Royal Commission effectively looked at the current regulations in place, whether it be for regulated credit or non-regulated, and have effectively left in place the current layer of regulations. What that means is that the Commission was all about compliance with the current regime in terms of regulation. In addition, Commissioner Hayne recommended there be no extension of the National Consumer Credit and Protection Act for small business, we've just heard. Effectively saying that lending for small business is a different animal than regulated credit. We also note there's been no recommended changes to the approach for remedies for irresponsible lending. So throughout the Royal Commission, Commissioner Hayne investigated and inquired about a number of FOS disputes, CIO disputes, and looked at outcomes where we had found irresponsible lending and made no recommendation around changes to those outcomes. I also note he made no recommendation that there be a waiver of debt where we do find there's irresponsible lending. Now I know that there has been some commentary and some sections have suggested that where we find there's irresponsible lending by a credit provider, the debt be waived, and that may act as some form of deterrence for the financial firms. So there was no recommendation around that. If the borrower has obtained the benefit of use of the loan funds, then the debt's not going to be waived. At the very least, the principal will remain repayable. I also noticed that Commissioner Hayne made no recommendation to change the obligations or the ability to obtain a guarantee where the guarantor is providing security over their primary place of residence in relation to a business loan. And there was some discussion around this during the course of the Commission hearings, but ultimately there's no recommendation around it or prohibition on it. There's some interesting points to note. So now I'd like to just give you some guidance on our approach to responsible lending complaints. It is under review, but some helpful comments to make at the moment on our interim approach. Effectively, the approach we're going to take, under the rules, we have a paramount obligation, and that is to do what we think is fair in the circumstances. Yes, we will have regard to the law and statutes, RG 209, the ASIC Act, NCCP Act, and the Code of Banking Practice. But ultimately, in the end, our paramount obligation, under the rules, is to do what we consider to be fair in the circumstances. And investigating these types of complaints, we will focus on the financial firm's actions and whether or not it met its responsible lending obligations, whether it be regulated or unregulated. And if we find it did not, then we'll have a look at what it would have discovered if it had met its obligations. What would it have discovered? It is possible for a financial firm to not meet its obligations, but in the end, if it had made adequate inquiries, it would have found out the loan was still affordable. So in that circumstance, there's no loss to the complainant. And I'd also remind you that for refinanced debts, where a debt is 100% refinanced, there also may be no loss to the complainant because they might have moved across to a better interest rate. So it's just another point to make there. The financial firm's obligations when lending are very well known at this point. I think for unregulated credit, we know that at law, the lender should exercise the care and skill of a diligent and prudent banker in selecting and applying its credit assessment methods and in determining whether or not the borrower can repay the debt. Now that's reflected in the Code of Banking Practice, but it's also an obligation found in common law. So it applies to unregulated and regulated credit. The NCCP Act, we know that the credit provider has obligations to make reasonable inquiries about the financial position of the customer and verify that information. Now, where we use the term requirements and objectives, and that's used in the NCCP Act and the National Credit Code, really requirements speaks to the features of the loan product, whereas objectives speaks to the purpose of the loan. We know that the financial firm has an obligation to take reasonable steps to verify the information and to assess whether or not the loan contract's not unsuitable. There's also the ASIC Act provisions indicated below on unconscionable conduct and misleading conduct. So as a lender, when they get a loan application, they really should be reviewing the financial position of their potential borrower, the main sources of income or all sources of income, customers' main expenses such as rent, repayments to other debts, even child support, insurance commitments, perhaps even gym memberships. Look at customers' discretionary expenses to the extent it's relevant, and also what part of their existing debts are going to be repaid from the loan that's being considered. The lender should also be looking at the credit history of their potential borrower, the number of dependents, the age of dependents, reasonably foreseeable changes of circumstance, and any red flags that may be apparent either in the loan application documents, or by way of corporate knowledge in the account statements and the account conduct if the customer happens to bank with them. It's all very valuable information there. And red flags really speak to conflicting information or information that would prompt or should prompt further inquiry. In terms of what we review, effectively we'll be asking for all relevant information from both parties. From the financial firm, we'll be asking for their full lending file, all the documents that were submitted at the time of the loan application, and all the relevant policy and other documents that fed into their credit assessment. And from the borrower, we'll be seeking all information relevant to them, not only the information they submitted when they applied for the loan, but information that indicates and supports their true financial position at the time. So as our banking advisors may need that information to assess whether or not the loan was affordable in fact. We'd also be looking at any red flags that should have prompted further inquiry, and we'd also look at the figure that the financial firm used for living expenses. And on that note, I'll just make a couple of remarks around benchmarks. Benchmarks was an issue that was certainly discussed in the Royal Commission, and we know that ASIC's Regulatory Guide 209 is currently under review, and that RG 209, when it's updated, is sure to provide further clarity around how benchmarks may be used by credit providers in assessing their customers' expenses. But the current RG 209 approach, and the approach we use, is quite clear, and that is that benchmarks, such as the household expenditure measure, is a second resort measure. A second resort measure so you can check the information that you've gathered through reasonable inquiries and verifications. It's not a replacement for making those inquiries. And if the declared expenses are significantly below HEMS, the benchmark, then that's a red flag. The question should be, why are their declared expenses so low? And that should lead to further questions around that issue. So let's see what the new RG 209 looks like when that comes out. What if a broker's involved? Well, we can look at claims that a broker didn't fulfil their duties. If a broker's involved, we'll look at whether or not the broker's involvement has any relevance to the claim. And by that I mean whether or not our complainant is alleging the broker has made any error or breach of obligation, or are they in fact saying, no, the broker's conduct's not at issue, it's the lender that has made the error or failed to calculate affordability. There are times when the broker's conduct will not be relevant, but at times they may make an allegation that the credit provider didn't meet its obligations and nor did their broker, and they may allege, for instance, we've seen allegations around an accusation the broker fudged or falsified information that was then passed on to the lender that the complainant didn't know about. If the allegation includes an allegation of wrongdoing against the broker, we'll look at whether or not there's any agency there, whether or not the broker's an agent of the financial firm. It may be that the broker is not an agent, in which case the financial firm won't be responsible for their conduct, but we can look at a claim against the broker as a standalone claim. Or if we think it's more efficient and effective, we may even join them so that the same case manager can investigate both claims together. So let's just briefly talk about remedies. If we do find there's irresponsible lending and they'll be liable to repay the principal subject to any repayments they've already made. But the lender cannot collect interest or fees on that lend. And so that we consider that to be the fairest of outcomes for both parties. We do have industry advisors that are an internal resource at AFCA, very experienced advisors who have spent a long time in the banking industry themselves, and they generally will be able to step in the shoes of the lender and assess whether or not the lender's met its obligations, and also make any calculations around the remedy. I should point out though there, the final bullet point is that the lender does not owe a fiduciary duty to its customer, and by that I mean it does not owe a duty to exercise its judgment on behalf of the customer and solely in their interests. So unless it's an investment advisor or something along those lines, the lender is not the fiduciary of its customer. So it doesn't have to do due diligence on its customer's proposed business investment. And that's something quite separate. And so oftentimes we have to manage our complainants' expectations around that type of claim. Looking at the regulated loans, purchase of an asset, we won't be looking at the choice of the asset or the price the complainant paid. The financial firm's only liable for the credit decision. We won't be reviewing claims about mechanical products such as a car without a third gear. But we will be looking at benefit of ownership. And a final example of that is property loans. For property loans, where we do find there's irresponsible lending, we'll basically look at a starting point of taking the principal borrowed, we'll deduct any repayments, we'll deduct purchasing costs, holding costs such as rates or sale costs, and we'll add back the benefit of use, such as any income if it's a rental investment or a nominal rent if they've lived in the property. And we'll then arrive at an adjusted debt figure and we'll say, right, that's the amount you now owe. And generally, we'll give the complainant 3 months or more to pay that, repay that adjusted debt figure by sale of the asset or otherwise. That approach is under review, but that's the current approach. If they can't repay that amount within the 3-month period, then they should surrender it. Final slide, Philip.
Thanks, Jeff.
Is if the funds raised are more than the adjusted debt, the sale proceeds, the excess sale proceeds go to our complainant. If there's a shortfall and it was their primary place of residence, we'd ask the bank to waive the shortfall, but if it's an investment property, the complainant is liable for that shortfall because that's part of their investment risk. Now, I'm aware of the time. Philip.
Oh, one quick question from the floor.
Yes?
Yes, there is one quick question
We do
from
have
the floor.
time for a couple of quick questions.
There are a number of questions that have come in online, which I think around the responsible lending that probably go to some of the more technical aspects. And what we'll do is we'll take them on board in finalising our approach document and doing a
Very
QA.
good.
So things
Very
around
good.
living expenses and how do we apply those and things like that, which we will take up. Thanks. Quick question.
Alex Khalil. Just in relation to business lending, what should we expect from AFCA in terms of assessing irresponsible lending for businesses?
Yeah, look, that's a good question. And we basically will treat it very differently from regulated lending. And that's because often business lending and assessing a business loan application is not a question of just working out income and expenses. We'd be looking at all the financials available, including cash flow projections. We'd be looking at the assumptions underlying those projections. We'd also look at the capacity and commitment of the borrower themselves who are seeking to run the business. So we'd look at their also collateral, the skin in the game that they're bringing to the table. And essentially what we're doing is we would make sure the business lens stacks up. And as we've noted earlier, and as reflected in the code, the lender still has an obligation to exercise the care and skill of a diligent and prudent lender in ensuring that business loan application stacks up. So they are very different from regulated lends, but we have in our banking advisor team, we do have a number of very experienced banking advisors from industry who have many years in assessing commercial loan applications, including in the franchise space. So we do treat them differently, but that's just some of the indicators we'd be looking at.
Thanks, Jeff. That was one of the questions that came through. So
Great, we'll cover that to some extent. Are there any more questions from the floor? Last one. In that case, on behalf of the AFCA team, I'd like to thank you for your attendance today. Thank you. Thanks to the panel.